Hello and welcome to this MPA and Hutchings webinar on selling your pharmacy in today's turbulent market. Now, what do we mean by turbulent market? Well, unsurprisingly, the pandemic has had an effect on all things pharmacy. But what effect has it had on pharmacy values and on the transaction process? And also, will the decisions being made by big multiple operators right now trickle down and affect pharmacy owners in the coming year? So discussing this and a lot more is Paul Steet from Hutchings Consultants. Say hello, Paul.
Hello.
Jamie Gill from Anson Solicitors.
Good evening, everyone.
And Artif Butt from Hutchings Accountants.
Hi, everyone.
So during this webinar, there will be a couple of live polls that we'll ask you to participate in. So when they pop up on screen, please just click on your chosen answer and we'll be able to collate those and move on. And then at the end of the webinar, there'll be a Q&A where you can ask our expert panel any questions you might have, as long as they're relating to pharmacy sales. And to do this, please submit your question by clicking on the Q&A button at the bottom of your video window and just typing in there. Any questions that you submit will be anonymous. And as long as we've got time, answered tonight. Anything that we don't have time to answer, then we will follow up with everyone directly over email after the event. I mean, not tonight probably, but definitely this week. So kicking us off today is Paul Steet, discussing things from a broker's perspective. And if, Paul, you are ready, I'll hand over to you.
Okay, thank you, Sam. Just bring up my screen. So the three presentations this evening will explain the process involved in selling your pharmacy business from valuation through to completion, taking into account the marketing, accountancy and legal aspects of the sale. We'll also cover briefly some of the most common issues that arise, which you should be aware of as a prospective seller. These various issues have the potential to seriously impact the length of your sale and could affect the eventual amount of money you walk away with on completion. Our aim is to highlight these now in order that you may take steps to remedy or limit their impact ahead of any future sale. The knowledge and advice we're sharing with you has the overall theme of seeking to minimise your stress during the sale and maximising the price you eventually walk away with. You can be assured that Hutchings Consultants, Anson Solicitors and Hutchings Accountants have years of knowledge and experience in pharmacy transactions and understand how pharmacy sales should work. Before I move on, as Sam mentioned, we are going to be running a couple of polls. The first poll I'd like to run now if we can. We're just looking for some feedback, just where you are at this point in time in terms of your the journey towards a sort of sale. So if we can run that poll, please, Sam and Kat, and we'll give everybody about 30 seconds, 45 seconds, just to complete that, if we may. Okay, so hopefully that's giving you some time to answer those questions, and thank you for doing so. And as I say, we'll run a second poll a little while from now. So let me just move forwards for you. So for those of you who've not sold through Hutchings Consultants before, I just wanted to briefly explain that we're the largest independent pharmacy-only agent in the UK. Our typical sales will range from single pharmacies with a turnover around £300,000 up to small groups with around £100 million turnover. We're approved and recommended by the MPA to its members for the selling and buying of pharmacy businesses since 2005, and are currently the only NPA supplier to reach platinum status. We have an excellent reputation in the sector, and we are clear we only work for you, the seller. For example, we don't take a fee from your buyer as well during the sale, nor do we take referral fees from solicitors or finance brokers we make introductions to. Therefore, there is zero risk of a conflict of interest arising during your sale, which could potentially create an issue. Overall, we have a wealth of knowledge and a broad range of experience in selling pharmacy businesses. This enables us to provide you with an insight on current factors affecting the market. Before I explain the process of valuing and selling your pharmacy business, I would like to briefly share with you what we've experienced in the market over the last 12 months, how the market has changed, and run through some key business performance indicators. As some of you may be aware, there's been a significant increase in the number of pharmacies entering the market for sale, most notably in the last 6 months. Many of these new pharmacies have come as a result of various multiples implementing divestment strategies, but we've also seen more independents coming to the market. In a small marketplace, this is a rapid increase over a relatively short period of time, which has impacted the market across England, Scotland and Wales. It's reassuring to see that the increase in opportunities has boosted buyer interest in the current market. I'll explain in more detail shortly which groups of buyers have been inquiring, but in respect of corporate disposals, these have generated interest from first-time buyers entering the market, existing owners seeking to grow, through to larger groups wanting to expand strategically. In the first quarter of 2023, we've instructed more than twice the number of pharmacy businesses compared to the first quarter of 2022, which demonstrates the level of selling activity we're currently experiencing. As for buyer interest and activity, in the first quarter of 2023, we've already registered 80% of the total number of new buyers we registered in the whole of 2022. So overall, it's been a very busy start to the year. So how has the market changed in 2023? Well, it's still early in the year, of course, but this first quarter has shown that the large influx of pharmacies has had different effects on the market. As mentioned, the number of opportunities for buyers to acquire has quickly risen, and many of these same buyers will no doubt wish to expand in future years, regenerating the sector. The corporate disposals have initially diverted many buyers away from the mainstream market. However, many of the opportunities have not come without their issues, and as a result, buyers have started to revert back. Across the market, timescales for a successful sale to complete have been impacted as well. The component parts of the market, which are essential to most transactions, such as banks, solicitors, valuers, and NHS local area teams, have seen a sharp increase in their workloads. This has led to some delays as those teams have worked hard to meet the challenge. A major outcome of these changes in the market is that as a seller, you need to be prepared for your pharmacy sale to take longer to complete, particularly if bank lending or the NHS change of ownership process is involved. Every pharmacy sale has its own unique set of circumstances, and if timescales are important to you, I recommend you contact either myself or one of my colleagues at the earliest opportunity to discuss how and when you are best advised to start your preparations. Now let's take a look at some of the key performance indicators we've seen over the last 12 months. In order to provide a benchmark comparison, I've used sales statistics for Scottish, English and Welsh sales completed for the period 12 months up to the 1st of March 2023. Please note that the following slides exclude any corporate sales data, as these sales are at a very early stage and haven't completed in any significant numbers. However, future webinars will incorporate this data into presentations going forwards. As a guide, pence in pound figures provide a broad overview of prices that are being paid for each pound of turnover. You will see from this slide that average pence in pound figures for sales in Scotland are still outperforming those in England and Wales by some distance. Scottish pharmacy sellers in recent years have benefited from a comparatively well-supported pharmacy sector paired with a sales market low in supply and high in buyer demand, which has boosted values to a degree not seen in either Wales or England for some time. Whilst there has been an increase in more profitable pharmacies entering the market in recent years, which has assisted in maintaining or even improving average prices, it's still too early to comment on what effect the large influx of various corporate disposals will have on goodwill values in the short to medium term. I must stress the point that the figures shown here are average prices achieved. Every pharmacy sale is individual, and there will be sales that have achieved a price below these averages and others that far exceed it. This next slide shows the average number of offers received per sale. You'll see on average there have been more offers per sale in England compared to other parts of the UK, which given the higher volume of sales and buys in the marketplace isn't necessarily surprising. Due to market conditions in Scotland, we have frequently used an off-market strategy to agree sales. This approach has meant that fewer potential buyers have been contacted, leading to a slight reduction in the number of offers required to agree a sale. This next graph shows the multiple of EBITDA, also known as the adjusted net profit, achieved on completed sales. As you can see, Scotland once again continues to outperform other parts of the UK by some way, reflecting the desire of buyers to acquire. An important key performance indicator of both sellers and buyers alike is the gross profit percentage margin the business is trading at. Over the last few years, we've seen an improvement across the board in average margins. This reflects the hard work invested by many owners who have recognised the need to focus on this area during these challenging times. With NHS contracts leading more to the provision of services and less focus on dispense and reimbursement, as well as rapid rises in certain drug costs, it'll be interesting to see what effect this will have on margins going forwards. The next few slides provide an overview of which groups of buyers have been most active over the last 12 months across England, Scotland and Wales. As previously stated, this data excludes any current corporate sales and focuses on completed sales over the last 12 months up to the 1st of March of this year. In England, the busiest category of buyers has been group owners seeking to expand or add strategically to existing branches. First-time buyers, who generally make up the highest proportion of new buyer registrations each year, continue to be very active in the market as well, competing with existing pharmacy owners for second place. Despite the many pressures contractors are under, it's been encouraging to see many seeking to expand when the right opportunity has presented itself. We've also seen past pharmacy owners rekindling their desire to own and run a business again, which is encouraging as well. In contrast to England, our recent sales in Scotland have been snapped up by group owners, in most parts due to their financial strength and expansion plans. This has led to some frustrated buyers, such as first-time buyers, looking at opportunities in the north of England or even further afield. The Welsh market has offered a little more scope to buy than the Scottish market in recent years. Interestingly, the multiples have been the most active group of buyers, followed by existing pharmacy owners and group owners. However, looking ahead, this is expected to change as many of the multiples are once again focused on selling as opposed to buying, it appears. Some buyers in Wales have started to become a little more cautious with their acquisition plans, largely due to concerns around the availability of locums and the desire to understand the implications of last year's contract change. As we're all aware, as we're living through a turbulent time currently and looking ahead into 2023, one would suggest this isn't likely to change anytime soon. The unsteady geopolitical situation with the war in Ukraine and the longer lasting effects of COVID and Brexit have created or exacerbated a variety of different pressures. Inflation has pushed up business costs. Locum staff shortages have contributed to wage increases, not to mention drug price and supply issues, all of which ultimately affect your bottom line profitability and potential value. In the absence of any additional government funding to help mitigate some of these issues, these pressures are expected to continue for the foreseeable future. In respect of the supply, we anticipate an increase in the number of pharmacies entering the market, although many of these are likely to form part of further corporate disposals as portfolios are trimmed to improve profitability or as part of wider company strategies. In the medium to longer term, an increase in pharmacies will open up ownership to buyers who otherwise might not have had an opportunity to buy. Many of these buyers will seek to expand in the future, providing further growth and regeneration to the sector. The unknown factor in the short term is what impact this will have on goodwill values. Most pharmacy deals require bank funding, and their desire to lend is crucial in supporting the market. Banks' appetite to lend to the sector remains firm. However, there is no avoiding the effects of any interest rate rises. Any rises ultimately impact loan repayment costs, which in turn feed into buyers' calculations and decisions when submitting their offers. Banks' detailed scrutinising of buyers' loan applications is expected to continue at a time when their teams are under heavy workloads. In order to streamline their work and costs, many banks are now unwilling to provide credit approval for loans until such time the prospective buyer has had their offer accepted. This can make it a little more challenging when assessing the financial strength of a buyer at offer stage. We anticipate that an increasing number of pharmacies will enter the market this year as part of both independent and corporate disposal strategies. Despite the many headwinds community pharmacy has faced over recent years, the sales market remains robust and potential sellers should feel encouraged. The key to achieving a successful sale in these challenging times is to employ suitably qualified and experienced advisors to guide and assist you throughout the process. If you are considering selling, I'd encourage you to contact Hutchins and speak to either myself or one of my colleagues. Once we have a better understanding of your individual position, we can share our recommendations personal to you. So that concludes the brief overview of the current marketplace across the UK. I'll now move on to explain the steps involved in taking a pharmacy business to market from valuation stage right through to completion. But before doing so, I think it'd be a good opportunity to run the second poll, as we're keen to understand what your thoughts are going forwards on how goodwill prices will be affected over the coming months. So can we please run that second poll, please? That's great. Thank you for that. Much appreciated your participation. So before we can start marketing, it's important to establish a value for your business and recommend a marketing price. A competent agent needs to understand your business before they can advise you, and will need to gather financial information from you to conduct a valuation. This is an example of the information we usually require. We don't wish to overburden you, but the more information we have at this stage, the more accurate we can be with the valuation. This will reduce the risk of disappointment for you when offers are called in. We review all the information supplied and produce an adjusted profit and loss. This establishes an EBITDA figure. We then calculate the value by adding a multiplier to this figure, and at the same point consider any other factors that can affect the value. Most sellers understandably want to achieve the best price they can when it comes to a sale. Many owners ask us which areas of the business they should focus on to increase its value. For most pharmacies, there are 4 key areas to focus on as they can impact the saleability and value of the business. Firstly, gross profit percentage margin. As previously mentioned, this is at the forefront of most buyers' minds when looking to buy a pharmacy. As I mentioned earlier, the average margin currently is around 33%. A slight increase in margin can potentially add significant value to a business. Take, for example, a pharmacy with a turnover of £750,000 and a gross margin of 30%, an increase of just 1% in margin could potentially add around £50,000 to the value by the time the multiplier is added to the net profit, assuming costs remain the same. Many of our clients advise us they're devoting more time to the buying side of the business and spending more time on researching the best prices. Working hard to improve your margin will be time wasted if you allow your business costs to run out of control. If you are planning to sell, it's so important to keep a tight rein on costs wherever you can. Both the buyer, their accountant, and lender will scrutinise your profit and loss account, and higher costs than the norm could raise some red flags. As previously mentioned, the sharp focus on costs should pay dividends when you come to sell. Item numbers. Even though the remuneration contracts are encouraging the provision of more clinical services, these are still hugely important in the marketplace. The vast majority of buyers in the market remain attracted to busy pharmacies with strong increase in item numbers. I appreciate if you are planning to sell, this may not be an area you wish to focus on, but it will increase the sellability of your business when you eventually do come to sell. Finally, it's important to leave some scope for growth in the business for a new owner. Buyers are excited when they see there are opportunities to grow a business further, and that in turn can help generate interest in your business from the market and improve its saleability. Buyers are less attracted to pharmacies where the current owners have maximised every possible revenue stream. However, it's important to note that in most circumstances, it can be hard to quantify exactly what the value of any potential is in the business. As a result, the market is pretty cautious when it comes to paying for potential, and lenders are unlikely to consider this to any degree as they attach more importance to proving past performance. The way to view potential in most cases is to use it to generate buyer interest and competition, which in turn should help achieve good offers from the market. So coming back to what's next in the process, we have the confidential meeting. This is an opportunity for the consultant to meet you and spend some time understanding your objectives and discussing any concerns you may have. The meeting normally takes place at the premises once the staff have left the day. This allows us an opportunity to view the premises without unduly alerting staff. Alternatively, if this isn't possible for any reason, we can conduct a mystery shop exercise, then meet you off-site at a suitable venue. During the meeting, we discuss and agree the marketing strategy, and it's another opportunity to answer any questions you may have. The next step in the process is preparing the sales literature. Our sale brochure is designed to be eye-catching to potential buyers and covers the most salient points of the business, demonstrating profitability and potential. The objective is also to provide sufficient information to buyers at an early stage in order to reduce the volume of questions they may ask. Marketing only commences once you've reviewed and signed off the final document and are happy to move forwards. Unless otherwise specified, a confidential listing is usually added to our website, as this generates buyer inquiries, but we take care to avoid disclosing the exact location of the pharmacy for sale. We also prepare a separate financials pack, which includes copies of the accounts, FP34s, VAT returns, OTC figures, and a copy of the lease if applicable. Before moving on, I wanted to talk a little bit about the different sales strategies we use to generate buyer interest. As I mentioned, we always discuss and agree with our client the most suitable strategy to use prior to the start of marketing. The most common strategy we use is a full marketing approach, but occasionally we will recommend to clients a more discreet off-market approach is taken. As I mentioned earlier, this is a strategy that we've used quite a lot in Scottish sales over the last year. Whichever approach we take, only potential buyers who registered with us and signed a non-disclosure agreement are contacted. With a full marketing approach, an initial shortlist of buyers is created from our database of several thousand registered buyers. When researching these buyers, the consultants will look at who is active in the marketplace and viewing or making offers, as well as who do we believe has the funds available. The consultants will also discuss the sale with other members of the team to seek recommendations. Potential buyers then receive the memorandum of sale, followed by the financials pack if they're interested. Buyers are followed up and viewings generated as a result. We keep the marketing under constant review, and the buyers list can be quickly expanded if necessary. The average period of marketing where viewings are taking place is usually around 6 to 8 weeks. As each pharmacy sale is different though, the marketing period can sometimes be shorter or longer than this depending on the circumstances. When it comes to the buyers making an offer, Hutchins use a structured offer process that's been tried and tested over many years. Occasionally, we may recommend to a seller they consider an individual offer, but in most cases, when we feel it's appropriate to set an offer deadline and call in offers, we will discuss and agree this with our client before setting a date. We use a formal offer template letter to avoid any misunderstandings. This is particularly important with company share sales, as they're usually more complicated. As part of the process, we request proof of funding and work to secure a deposit from the buyer if their offer is accepted. This is usually no less than £20,000. Following the initial round of offers, we provide some general feedback to buyers before calling in the best and final offers. This allows interested parties to fine-tune their bids and helps increase the competition between them. The competition generated allows us to negotiate the best price and terms possible. Once an offer is accepted, we then move into the legal stage. I won't go into too much depth about this, as Jamie Gill will cover this area in more detail for you, but we arrange for the buyer's deposit to be paid across to your solicitor, who holds the monies in their client account. The deposit monies are held in accordance with a legally prepared deposit and exclusivity agreement, which both the buyer and seller are asked to sign. In exchange for paying a deposit, the buyer is granted a period of exclusivity, whereby other potential buyers are excluded from making an offer. We then issue the heads of terms to all parties involved, including the professional advisors, confirming the sale. Our role as an agent then changes from one of marketing to that of sales progression, as we consult with all parties during the sale to ensure the sale is progressing forwards. Once an offer is accepted, an average timescale to reach completion is around 6 to 9 months currently. However, there are many factors that can slow this down, such as bank delays, the NHS change of ownership process, and lease issues, to name but a few. As I come towards the end of my presentation, I wanted to briefly highlight 3 of the most common issues we see either prior to or during the marketing phase of the sale. These issues can adversely affect the sale and even the final purchase price, which you as a seller obviously want to avoid if possible. The first common issue is around short leases. A lease is generally referred to as short in the pharmacy sector when it has less than 10 years remaining on the term unexpired. As most buyers require bank funding, they will be obliged to accept the lending terms offered by the lender. This can potentially become an issue for a buyer and ultimately a seller when the remaining term is less than 10 years, as the bank will usually match the term of the loan to the remaining term of the lease. It's becoming more common now for lenders to specify there must be 15 years remaining on the term of the lease at the outset of the business loan. A short lease can therefore mean the buyer has less time to repay the loan, significantly increasing the monthly loan repayments. Knock-on effect can be that the buyer has to reduce the amount of their offer, or in a worst-case scenario, curtail their interest due to the deal becoming unaffordable for them. I strongly recommend, if you're a leaseholder, that you take the time to check your lease to see if this could potentially affect you. If it does, I recommend you take advice and consult with ourselves and/or a pharmacy sale experienced solicitor such as Anson's before approaching your landlord to extend or renew your current lease. I can't emphasise this enough. It's vital you employ a solicitor with pharmacy sale knowledge to review any new or revised lease before signing. If you don't seek that advice and sign a lease which isn't fit for purpose, you possibly risk seriously affecting the value and saleability of your business. The second most common issue we come across is FP34s in an incorrect trading name. In most cases, it tends to arise where a contractor has changed from trading as a sole trader to a limited company. It's commonly overlooked or not considered as a high priority at the time, and therefore doesn't usually present as a potential issue until much later on when the sale is considered. If selling a limited company and the FP34s are still in the sole trader name, it's essential that they're changed over as soon as possible, as they could potentially prevent your sale completing. If selling as an asset sale, it isn't necessarily an issue, as a buyer will need to apply for a change of ownership and possibly fitness to practice as well through the NHS process. But again, this is something that should be looked at and considered and advice taken if necessary. In my experience, changing the FP34s can be either an easy quick fix, or it can lead to significant delays. If it can be proved that the local area team was notified of the change in trading status of the contractor, it should hopefully be just a quick clerical change. However, I have had instances where the sellers have had to apply for fitness to practice and change of ownership in order for the change in FP34s to be actioned. It usually takes months to complete the process through PCSE and can add undue stress and delay if engaged in a sale at the same time. Again, I strongly recommend that if you believe this might affect you, that you take steps as early as possible to rectify the situation and avoid the unnecessary extra stress. The last issue we encounter is a lack of financial information or poor quality information provided to buyers by the selling party, which can cause delays to buyers obtaining the bank support they need. As mentioned earlier, banks are heavily scrutinising loan applications and the performance of the target business. In these times of rising costs and interest rates, the banks are adding stress tests to ensure that the risk of a buyer defaulting on their loan is minimised. The days when banks would take a light touch on loan applications are long gone. They now need to undertake in-depth financial due diligence on the target business, and the way they achieve this is through the financial information provided. Therefore, if there are missing pages on the accounts or missing VAT returns, for example, be prepared to receive a request to supply them. Accurate and up-to-date financial information can help create confidence in your business for both the potential buyer and the lender. There's a very high volume of applications going through lending teams currently, as I mentioned. I would hazard a guess that they're more likely to process those applications quickest, which contain all the information they need without having to chase down documents. So it's definitely in your interest as a seller to be in a position to provide it when needed. The information we request from sellers to undertake the valuation will largely cover what the lenders need to see. So if we do come back to you for missing information, please bear in mind that ultimately this is done to ensure that your sale is as smooth as possible for you. When considering selling, it's important to appoint an agent who can provide guidance, support, and is prepared to work hard to achieve the best outcome for you. The team at Hutchins Consultants and our sister company, Hutchins Accountants, strongly believe that we have the necessary expertise, knowledge and skills to manage a sale and achieve the best price the market will pay for your business. At Hutchins, we have a close-knit team who have over 130 years combined knowledge and experience selling pharmacies. We take pride in the service we provide to our clients and work hard to achieve the best outcome for them. Our experience ensures we can oversee your sale right from the start through to completion. Although we regularly travel around the UK, our team is based in one central office, which allows us to quickly share intelligence on buyers in the current market. We collaborate closely with our colleagues at Hutchins Accountants. If an accountancy related issue arises during a sale, we can quickly call upon their specialist accounting experience for their advice. So many times, their valuable assistance has helped keep a sale on track, which otherwise might have come unstuck. We have a large database of potential buyers who have registered from across the UK. They range from eager first-time buyers through to the multiples who we have strong contacts with. This allows us to attract potential buyers for a pharmacy quickly. Finally, we have a straightforward, no sale, no fee agreement. There are no upfront marketing costs at all, and we only receive our commission once your sale is completed. We only act for our client, the seller, during the sale. We're clear we do not act for the buyer or take a fee from them. This is important as you can be assured when selling through Hutchins that your buyer will have all the funds put forward to you, as opposed to giving some reserved to the agent. And that's important that you make sure that you're getting all of the offer, all the funds which should be coming to you. So that concludes my presentation for this evening. If you'd like to discuss a potential sale, please do not hesitate to contact me or my colleagues. We can offer you a free verbal valuation and a free tax review. And we can also arrange a confidential meeting with either myself or one of my fellow consultants at your pharmacy. I'll now hand you over to Mr. Jamie Gill of Anson Solicitors, who will explain his important role in the sale of a pharmacy business.
Thank you, Paul. Bear with me. Good evening, everyone. My name is Jamie Gill. I am a solicitor and director at Anson Solicitors. I'm joint head of corporate department and I am a lead in the pharmacy team. Just briefly about Anson Solicitors, we have over 10 years experience in the pharmacy sector. I would expect we've completed probably well over 250 transactions in that time. We have a very experienced team used to dealing with pharmacy transactions, including one of our directors who used to be a pharmacist, in fact. We act for a range of different types of clients, from first-time buyers, sellers, up to large national multiples. We have a national reach, so we act for clients south of England, across Wales and the north of England as well. And we act in all aspects of a transaction, so we can act for buyers, sellers, we deal with refinancing and also property issues as well. Paul and his team have asked me here this evening just to give everyone an understanding of the legal process of a pharmacy transaction. So what I will go through is the legal steps. Paul has touched on what I would call the pre-legal aspects already: preparation, going to market, instructing agents, etc., etc. So I do not intend to touch on that. Where we tend to get involved in any transaction is when we have a deal agreed. So that would be when the structure is being agreed, heads of terms are being agreed, exclusivity and deposit, as Paul has already touched on. And then that leads into the formal legal process, at which point we will take over on the legal aspects of the transaction and manage it to the finish in conjunction with Paul and his team and Artiv as well. The legal process will include the due diligence, the agreement, the property, of course, and I'll touch on a couple of key issues at the end. Okay. First important point to note, I think, really is the structure of the transaction and how this can differ. So essentially, there are two main sale structures: an asset sale or a company or share sale. And there's also a hybrid, which I'll touch on at the end. I've set out the key differences there on the slide, and I'll just run through them. With an asset sale, the company or the sole trader is selling the goodwill, the business assets of the pharmacy, and so an NHS application for change of ownership will be required. As Paul has mentioned, it can take some time to go through, so we advise that that's addressed as early as possible. Where you are selling the company or the shares in a company, the NHS contract will remain with the company, and so no such application is required. The next key difference really is the employees. Again, with a company, a share sale, the employees are engaged, they're employed by the company itself, and that will not change on the change of ownership of the company. However, when you're selling business and assets, the employees are very much protected by what are called the TUPE regulations, and they protect the employees, giving the employees the right to transfer to the new owner of the business on their same terms. There is a process to be followed, and our role is to make sure that process is followed correctly, and to protect the buyers and the sellers from any potential claims for failing to follow that TUPE process. The next point really is what assets are included. So on an asset transfer, a buyer will very much pick and choose the assets, the main ones being, of course, the NHS contract, any other key contracts with the business. They'll take over the employees, the property aspects, all from effect from completion. Compared to a company where everything will sit in the company, it will remain there, and the buyer will take over everything, including everything historically as well. And so it's very important that the difference is understood and what the buyer is expected to take over. Particularly with an asset sale, the assets can be a point of negotiation. Property is also a key difference. Again, with a company, most things will remain as is, as will, for example, the lease, assuming there are sufficient unexpired term on that lease. But with an asset transfer, you'll need to assign or transfer that lease to the buyer. It may require an extension, or a new lease may be required, and we will assist with that process. Risk on an asset transfer will take place from takeover. So a buyer will assume risk of the business at the point they take over ownership. With a share purchase, the buyer is taking over the historical risk as well as the future risk of the business. And so it's important that a buyer does understand everything in that company. The price, which I'm sure Atif will touch on later, will, in an asset transaction, be paid on completion, with a payment in addition on account of stock to follow, normally a week or so following completion once the stock take has been finalised, compared to a share transaction where the price agreed typically is for the goodwill and then is adjusted upwards or downwards depending on the net asset value of the business at the time of completion. And finally, timing. With an asset transfer, you are generally subject to third parties, the NHS, landlords, banks, of course, and can take a lot longer to go through. And with the share transaction, because everything generally is remaining as is, the process can be done in a lot quicker timescale. And sometimes that's important for a buyer and a seller. Also mentioned hybrid, and this is sometimes as part of a restructuring. So sellers may transfer the assets of a business into a subsidiary or another company, for example, and then sell the shares in that company. That, in a way, has to bear in mind many of the factors above, particularly in terms of timing, to be aware of. Once the structure has been agreed, as Paul said, heads of terms will be drawn up. This will set out the key terms of the transaction, namely the purchase price, the structure. It'll often include a target date for completion and how the property is being dealt with. Paul also mentioned exclusivity. So this is to protect the buyer when he is discussing, negotiating, carrying out his due diligence investigations with the seller. During that period, a seller would not be permitted to engage with any other third-party buyers. The buyer is spending time and money, and so they want the comfort to ensure that they are the only person the seller is speaking to. Typically, this lasts for 3 months. Can be shorter, can be longer, depending on the circumstances. And finally, the deposit. As Paul said, they typically arrange around £20,000. Again, to protect the seller. Sellers often find it beneficial to know that the buyer is serious, they do have the money, they do want to proceed. And in certain circumstances, the buyer will sacrifice or forfeit that deposit if, for example, if they did not proceed for a particular reason. Equally, if the seller did not choose to proceed with the transaction, the deposit would be returned to the buyer. It's important that both buyer and seller understand the terms of that deposit agreement, and we're more than happy to give some advice on that. So, as I say, at the heads of term stage, that's when we get introduced to the client. And the first step in the legal process is due diligence. Due diligence is investigations into the business, into your company. A buyer wants to know what they're buying. They want to know if there's any skeletons in the closet. It's a way to understand what issues there are, what they're getting into, and whether they need to be aware of anything moving forward that they're taking on. Excuse me. The due diligence process is generally, the due diligence process is generally split into legal and financial. So from a legal point of view, this is where ourselves, we would assist. So buyer will submit a fairly standard set of inquiries. This will cover all aspects of a transaction, such as the assets, the contracts, the employees, the property, compliance issues, NHS issues, etc. They're going to ask lots and lots of questions into all these areas just to understand what it is they're taking on. They're spending a lot of money. They want to make sure that everything is as it should be. It isn't always, of course, and that's where we can help. We can assist sellers with preparing the replies to inquiries. We can assist sellers with correcting any issues, dealing with any compliance issues, getting everything in place and everything in order. This, in turn, will result in the buyer having less opportunities to chip away at any purchase price. So they're looking to work out what issues there are. They want a reason to come back to you if there are issues, to reduce potentially the purchase price, for example, or to recover losses in the event that the issues that come to light cost them money moving forward. Separately, there is financial due diligence, and this will run in concurrence with the legals, and this is where Artif and his team will come into play. They will look into the accounts, the finances, the tax. Ultimately, the goal here from a seller's point of view is to protect the value of the business. And the best way to do that is preparation, having everything in order as early as possible. And it is always helpful, and we're always happy to have a chat with any sellers early on to give some initial advice on how that may be best achieved. The next and most substantial part of the transaction is the agreement, commonly known as an asset purchase agreement or a share purchase agreement. APA, SPA is also what they're commonly referred to as. Fundamentally the same in terms of content, but there are some notable differences. The asset purchase agreement will set out the assets that you are selling, the buyer purchasing. It will also set out assets which are not included. It will set out the purchase price and any mechanism that goes with that, the stock valuation policy, any completion mechanics, for example, what the buyers and the sellers will do at completion, any obligations. And one of the most fundamental parts of the document will be the warranties. Now, the warranties, they are statements given by sellers in respect of the condition of the business. And these warranties will touch on many areas that are covered in the due diligence, such as the employees, the property, compliance, for example. And these statements are given by the seller at completion. And what they do is they give the buyer comfort, they give the buyer a way of recourse in the event that those warranties turn out to be incorrect, for example. So picking on employees, you may give a warranty that states there are no ongoing claims with any employees. Okay. If after the buyer has taken over the business, it turns out that there is an issue with an employee that you did not give information on, that may be regarded as a breach of warranty, and it may give the buyer the opportunity to make a claim against the seller in the event that they incur a loss as a result. So how we get around this is we go through what is known as the disclosure process. And as acting for any seller, what we will do in that disclosure process, whilst negotiating those warranties with the buyer to make sure that the risk apportionment is fair, we will go through those warranties with any seller line by line to make sure that we can disclose against those warranties accordingly. So if one of those warranties we know is not correct, we can disclose the true information against that warranty. And what that will do is that will prevent a buyer being able to make a claim against you because they're aware of the particular situation. And we will spend quite a lot of time going through that with you. It can take sometimes a whole morning or afternoon to do that process. But arguably, it is one of the most important processes for you as a seller to go through, and we will handhold you through that. This works in tandem with the indemnities. So a breach of warranty can enable a buyer to make a claim for any potential losses or damages they've incurred as a result of that breach of contract. They have to show loss, they have to show a reduction in value of the business that they've acquired. An indemnity is slightly different. It's a pound for pound reimbursement. And what a buyer will do is if they have identified a particular issue, whether through due diligence or disclosure, they will seek to protect their position moving forward by way of an indemnity. And these are often hotly negotiated, as you can imagine. The buyer will want to ensure that any risk that they are taking on that was incurred or happened during the seller's watch, it is not essentially for their pocket, and will want the pound for pound reimbursement protection in the event that a loss is incurred as a result. These are not unusual, but we work hard to reduce the scope of these indemnities to the particular issues if we feel there is a real risk. The warranties and indemnities work alongside the seller protections. So it's not simply a matter of a buyer incurring a loss and making a claim against a seller. We would put in, acting for the sellers, a whole range of protections. And this will include financial limits, time limits on claims. So any claim would need to be of a certain value before it could be brought. For example, it would need to be brought within a certain time period after completion. It's not an indefinite liability for sellers. We would ensure that buyers claim against insurance policies, for example, or third parties where appropriate before coming or pursuing the sellers for any breach. Having said that, warranty claims and indemnity claims actually are very far and few between. Carrying out a thorough disclosure process, a thorough due diligence process, just limits the opportunities that really a buyer will have to make any claim, and that's really where we come in and will assist you. And finally, just to touch on seller restrictions. So the buyer is going to be paying good money in most cases for the business from you as a seller. As part of that process, you would be expected to enter into anti-competitive restrictions. And this would mean, for example, not setting up a business in competition in the local area, not poaching patients, suppliers, employees, for example. The buyer, rightly so, is paying good money and wants to make sure that they can have a good go at the business moving forward. They don't want to pay substantial sums to you for you only to set up next door and continue running it as a similar business, which is fair enough. So it's important to understand that moving forward, you would be expected to step out of that particular area. That doesn't prevent you from operating in other localities, of course, but just something to be aware of. Next point to touch on, again, quite an important point, which Paul has also touched on as well, is the property. The NHS contract, as you all know, is linked to the property. It's crucial. The funders are particularly keen on the property aspects. Leasehold is probably the most common way of occupation in terms of property. As Paul's indicated already, lease term is particularly important, 10 or even 15 years being favoured by lenders. It's important that we deal with the assignment properly, whether we need it. We need to know whether we need an extension or even a new lease, for example. That brings me on to third-party landlords. 9 times out of 10, we are likely to be dealing with a third-party landlord. Sometimes you are your own landlord, which is fine. Because of this, third-party landlords, they have no motivation in the transaction. They're not interested. They will go at their own pace. It's therefore important to approach them early, get them engaged in the transaction early on, particularly if we are expecting an extension in terms of the lease or whether a new lease is likely to be required. They're also going to want their costs covered, and typically I'd expect this to be covered by buyers, but sometimes this may need to be covered by sellers as well. Okay. So third-party landlords, as I say, can be one of the reasons why a transaction can take a long time. And so dealing with that early on is important. Finally, just touch on freehold. It's not unusual for you to own the freehold in which you occupy and essentially lease it to yourself. Again, which is common in pension planning, the freehold may be retained by the seller or extracted and leased to the buyer. Again, that's something that we see quite often, and we can assist and advise you in respect of that. So really just touching on some key issues that we typically come across. As Paul has already indicated, and I'll just reiterate the point really, the NHS contract, making sure that is in the right name. It is really important. It can delay the transaction anywhere from 3 to 6 months, depending on the local area team. You've got to remember, we've got to take into account the appeal period and the 30-day notice of commencement. So dealing with that early on, getting that process started early on is important. We can, acting on your behalf, we can put in place protections, side letters to give you the comfort that whilst the process is ongoing, in the event that the transaction does not proceed, we can ensure that the process is either stopped and or the contract is transferred back into your name. As Paul also mentioned, advisors, having pharmacy experienced advisors, I cannot emphasize this enough, is so important. Having the guys at Hutchins acting as agents, they know what they're doing, having legal advisors who know what they're doing, and financial advisors like Artif who know what they're doing on pharmacy matters, but not just pharmacy related issues, also transaction experience is crucially important. When we deal with transactions where there are not professional advisors who are used to giving pharmacy advice, it's challenging from our point of view, because we learn to focus on the key issues. It can prolong the process, and just increase costs, increase time. So having good advisors in your corner is so valuable. And finally, preparation. Preparation is key on any transaction. The due diligence is having everything in order in good time is the best way to protect the value of your business. Speak to your accountant, your tax advisor on any restructuring, making sure that the transaction is as efficient as possible for you, particularly from a tax point of view. And just and sometimes this is 1 to 2 years in advance you're looking at this. It will could have significant impacts on you financially, and it just ensures for a smoother process. So for us, as I say, my name is Jamie Gill. Anson Solicitors are experienced in the pharmacy market. We're able to advise you from start to finish on any transaction. We will work hand in hand with the guys at Hutchings to ensure that the process is as smooth and as seamless as possible, identifying any issues, addressing them. If anybody would like the benefit of just sort of 20-30 minutes of time, my contact details are on the screen there. More than happy to have a chat with anyone. Please just drop me an email and we can arrange a time to have a quick chat. Okay, that's it from me. And I think Atif, you're next, so I'll hand over to Atif to talk you through from his point of view.
Lovely, thanks very much, Jamie. Hi everyone. My name's Atif Butt, and I'm the Senior Accountant at Hutchings Accountants, where we've been specialising in pharmacy sales across the UK for over 30 years. Today, we're talking about selling your pharmacy in today's turbulent market. We'll look at the main steps of a pharmacy sale, some of the issues we see coming up along the way, and how you can best be prepared for them. We've heard some excellent points from Paul and Jamie about coming to market and the legal aspects of a sale, and now I'll be focusing on accounting and tax matters so you can get a comprehensive idea of what you need to be thinking about and when. We'll be covering preparing for sale, looking at some pre-sale issues, due diligence, the legal process, completion, the completion account, and what happens after completion. Let's start by talking about the first step, preparing for sale and understanding your tax position. If you are thinking of selling your business in the future, it's never too early to start getting ready, even if you don't plan to sell for many years. Being properly prepared makes a huge difference, not only in the price you get, but also in how much you'll be left with to enjoy in your retirement after paying the tax man. This has never been as important as it is now, with a number of risks and uncertainties facing the pharmacy sector and beyond. Recent events such as the COVID pandemic, Brexit, and the war in Ukraine have changed our lives in a way that would have been unimaginable a few years ago and contributed to rising costs in a number of areas. With inflation and interest rates still going up, the economy is facing an unprecedented challenge, and we're likely to see changes in tax rates and reliefs coming in the near future. The recent budget confirmed changes to the capital gains tax annual exemption, which is being reduced from £12,300 to £6,000 from April 2023 and down to £3,000 in April 2024. Capital gains tax is an obvious target for change as it's currently charged at lower rates than income tax. The government has made significant changes to entrepreneurs' relief a few years ago, which I'll talk about in more detail later, and it's possible we might see further changes to come or even the relief being abolished completely. Sector and market conditions. Paul's talked about the current state of the market and how it's been affected by current events. But as we've seen, there are a number of factors that can change things significantly over the coming years. Of course, it's impossible for us to accurately predict what's going to happen now and in the future, but the best way to manage these risks is to be prepared. Once you've decided you want to sell your pharmacy, be sure to get specialist advice that takes your individual circumstances into account. This will help you work out the best strategy for the eventual sale, having considered the accounting, legal, and marketing perspectives. At Hutchings Accountants, we start by reviewing your accounts and tax position to recommend the most tax-efficient way to structure your sale and extract the profits. Getting this right can have huge tax implications that could make a difference to your sale of hundreds of thousands of pounds. It's really important to look at this as early as possible, as getting the best tax treatment sometimes involves making changes to the business years in advance of an eventual sale. If your pharmacy is trading through a limited company, the sale can be structured as a share sale or an asset sale, as Jamie explained earlier. To decide on the right structure for a company sale from a tax point of view, we calculate what your estimated tax bill would be from each option, as there's a considerable difference in the tax treatment. Share sale means you'll be taxed personally on the gain and pay capital gains tax. An asset sale would mean the company selling the business and paying corporation tax, and you being subject to a further tax charge when you take out the profits. If you are considering a company share sale or personal asset sale, you may qualify for Business Asset Disposal Relief, or BADR, formerly known as Entrepreneurs Relief. BADR is a relief that can apply when someone sells part or all of their business, and means you only need to pay tax at a rate of 10% on the gains, as long as certain conditions are met. Each individual has a lifetime limit of £1 million worth of gains that can qualify, which has been reduced from the previous lifetime limit of £10 million. In a share sale, the qualifying conditions for the relief are that you need to hold at least 5% of the shares and voting rights and be either an employee or officer of the company, which must also be a trading company. These conditions have to be met for at least 24 months before the disposal. So, without BADR, if you were to sell your business for £1 million, you would be liable to capital gains tax at 20%, which is £200,000. But if you qualified for the relief, this would be reduced to 10%, meaning you'd only need to pay £100,000, which is a huge tax saving. However, there are circumstances where you may not qualify for the relief, which we'll talk about a bit later on. If you're considering selling your pharmacy in the next few years, it's worth thinking about how you can increase the business's value before you sell. We recommend that you get a professional valuation by a pharmacy specialist and work with your accountant so you can identify the key performance indicators affecting the value and look at how these could be improved over time. Your accountant can also review your tax position to see if there are any other issues that might increase your tax bill and work out the steps necessary to resolve them to ensure you get the most favourable tax treatment when the time comes. Looking at this ahead of time gives the opportunity to plan and map out a list of prioritised targets you want the business to achieve and a timeline over which you want to achieve them. This can be things like reducing stock holding and wastage, improving the business gross profit margin, reducing staff costs, or making sure the sale qualifies for BADR. The aim of this process is to increase the value of the pharmacy as much as possible before it's put on the market. It's important to remember that every £100 spent on getting the right professional advice can increase the profitability of your business by thousands of pounds, which in turn can increase the value of your pharmacy by tens or even hundreds of thousands when it is time to sell. Now, as we've said, preparation is key, and it's worth looking in a bit more detail at some of the things that we commonly see in pharmacy share sales that can cause problems or present opportunities. I talked earlier about the conditions for business asset disposal relief. If you have a company with more than one share class, this may need to be looked at, as some of the shares may not qualify for the relief at present. Your company also might not qualify if it owns too many investment assets or holds too much cash, as there is a risk that HMRC would no longer consider the company to just be a trading company and would say it's also engaged in investment activities. As we said before, each individual has a lifetime limit of £1 million of gains that can qualify for the relief. So if you've ever sold or incorporated a business before, you may have benefited from the relief already and used up some or all of your allowance. Also, if your sale proceeds are over £1 million, they won't all be covered by the relief, and some will be taxed at 20%. However, all of the above can be dealt with if you have enough time and the right advice. When it comes to BADR, it's important to identify any problems as early as possible so you can take the necessary steps to remedy them. As well as affecting BADR, the level of cash in the company can have other implications on your sale which may need to be carefully considered. It's not unusual in pharmacy sales for us to see high levels of cash being retained by the company at the point of sale. For a seller, this can be desirable because it lowers their overall tax bill, but a buyer may not want to take over the company with such a large bank balance, as they'll effectively need to pay for the cash with more cash, which they may need to raise from a lender. In such cases, it's usually possible to arrange for a cash extraction at completion, where the seller can effectively take out the excess cash, leaving the buyer with enough for their working capital needs. Investment property owned by a company can cause problems with BADR, but we also commonly see pharmacy companies that own the trading premises they operate from. Sometimes these are included in a business sale, but there are cases where the business owners want to take them out of the company before the sale so they can give the new owners a lease and benefit from the rental income. It's important to take advice on the most tax-efficient way to do this ahead of time. Another important area that's worth considering early on is what you want to take from the business in the form of salary, pension contributions, and dividends in the years leading up to your sale. Tax rates on salaries and dividends are generally much higher than the 10% rate you can achieve on sale with a BADR. So it makes sense to take less salary and dividends from the business if these are going to be taxed at a higher rate in the period leading up to your sale. This will mean the company's cash balance will be higher at the point of sale, and care needs to be taken that it's not so much that HMRC no longer consider the company to just be a trading company and BADR is lost. But it is important to remember that some dividend income is taxed at 8.75%, which can represent a tax saving over the rate you're going to get on the sale. So it's well worth engaging in some tax planning in your final years of ownership to make sure you optimize your takings so that you're paying the lowest rate of tax overall on your lifetime earnings. Now, these are some of the things to consider before a sale, but now let's talk about what happens once you've found a buyer. Jamie set out the main aspects of the legal process earlier, and once your buyer pays their deposit, the next steps are the due diligence process and finalising the sale agreement. As accountants, our job is to work alongside your legal team to make all of this run as smoothly as possible. The due diligence process gets underway and the buyer's accountants request a list of information. In a share sale, the buyers will want to go back over several years so they can be as comfortable as possible about the history of the company. Your lawyers will go through the sale agreement with the buyer's lawyers to agree a finalised version. Your accountants will also review this from a tax and accounting perspective, suggest any changes to the main terms and covenants, and carefully go through the warranties to make sure the buyers are made aware of any exceptional events or circumstances. You can see how important it is to engage accountants and solicitors who specialise in pharmacy sales to get this bit right. Because pharmacy is all we deal with and we see so many sale agreements in the course of our work, we know what's appropriate and what is excessive to warrant. And so with our combined experience, we're able to limit your risk. As Jamie said, in a share sale, the total amount you receive for selling your shares is made up of the agreed price for the goodwill and fixed assets of the business and an adjustment for the net asset position of the business at the point of sale. The net asset position is made up of the company's current assets, which are things it owns or is owed, like cash, stock, debtors, prepayments, and money owed by the VAT man, minus the liabilities, things it owes out, like money owed to suppliers or HMRC. If there are more assets than liabilities, an additional payment is made for the net asset value. But if the liabilities are more than the assets, a deduction is made from the goodwill payment. When the buyers are happy with the results of the due diligence exercise and the sale agreement is close to being agreed by both parties, a target completion date is agreed for ownership of the pharmacy to transfer from you to the buyer. It's generally helpful if the completion date can be at a month end, as this makes it much easier to calculate the position at the point where the business changes hands. Once the target date for completion has been agreed, we need to provide the buyer's side with an estimate for the company's net asset position at that date. Of course, we're unable to provide exact figures at that point, so we estimate this as best we can. This gives the buyer an idea of the net current asset payment they will need to make in addition to the payment for the goodwill and fixed assets. Once completion accounts have been agreed by both parties, several months down the line, a final payment can be made for the actual amount due as per the accounts. When we review sale agreements, there are a number of things we look at carefully. For example, proposed method to calculate the net current asset figure, as this will affect your final payment. The agreement also sets out the terms by which the business must produce the completion accounts and what the procedure would be if the accounts were not agreed by the buyer. We also go through the tax warranties in the agreement very carefully and cross-check them with the company's accounts for the last 3 years to produce a list of any facts and circumstances that need to be disclosed to the buyer. And these are then collated by your solicitor in the disclosure letter. The tax warranties are very detailed and refer to numerous statutes from tax and company law. So it's essential they are looked at by an experienced accountant familiar with both your business and pharmacy sales. Putting the time in to get this exercise right means you can sign the sale agreement with peace of mind and confidence that your interests are protected. After completion, the next thing we need to consider is the completion accounts. These need to be prepared with extra care and attention to detail to make sure that they are in line with the sale agreement and also represent the closing position as accurately as possible, so you can benefit from all the profits from your period of ownership of the business without paying for any of the business expenses from after this date. Once the accounts are prepared on this basis, they're sent to the buyer's accountants, and under the terms of the sale agreement, they have a specified period in which to inform us of any disputes or to accept the accounts. After reviewing the accounts, the buyer's accountants will either accept them or send a list of any items they believe should be included or removed from the accounts. For example, payments made by the company after completion that they believe were incurred before completion. We would go through any points of dispute and try to agree them with the buyers and revise the accounts accordingly so that they are acceptable to both parties. The buyer will then release the final balancing payment for the net current assets, which means you've now received full payment for your business. The final step is declaring the sale on your personal tax return and calculating and paying the tax due. The sale will fall in a tax year ending on the 5th of April and would need to be reported in your tax return for that year. This would need to be submitted in the tax paid by the 31st of January the following year. As an example, if you sold your business on the 1st of January 2023, this would fall in the 22-23 tax year, and your tax return and payment would be due to HMRC by the 31st of January 2024. If you received a total of £1 million for your business and its assets and paid professional fees of £50,000, your total gains from the sale would be £950,000. And the capital gains tax due on this after the application of your annual allowance and business asset disposal relief would be just under £94,000. Once we calculate your tax bill, we can also advise you on ways you could reduce it. If you haven't already, you should take advice on estate planning and your will. It's also worth considering your exposure to inheritance tax, because when you own your business, you benefit from business relief, which means if you were to die, the business assets would be outside of the scope of inheritance tax. But once the business is sold, business relief no longer applies, and your share of the cash proceeds would be liable to inheritance tax if you were to pass away unexpectedly. We also advise all of our clients to talk to an independent financial advisor who can guide you on investments you can make for a tax-efficient income in retirement, so that all you need to worry about is what to spend the rest of your money on. That's all for me. Thanks everyone for listening. we're now hopefully going to move on to some questions if we've got time.
Hey, Artif. Yeah, I think we've got time. I would like my only worry to be what to spend my money on. Can you make that my only worry, please?
Maybe one day, Sam, maybe one day.
Yeah, okay. All right. Hold you to that. Brill, thank you so much, Artif. And also thank you, Jamie, Paul. That was really great. I mean, obviously I know all this stuff, but it really is good to just hear it in the context of current conditions. Some things have changed a lot, and some things are kind of back to normal. I think the things that have changed may have changed forever, but I guess we'll see. Nothing stays the same, I guess. So there have been a huge number of questions that have been coming in, and thank you so much for submitting your questions today. We're going to get through. We always do this. We kind of have so much to say, we run over a little bit. I want to make sure we answer, a few of these questions, and everyone who has asked a question, we will follow up with you directly over email, so you've got a kind of a full response from whoever it makes most sense to be answering the question, from the brokerage, the accountancy, or the solicitors. But I would like to try and get at least a couple are done, perhaps even just short answers. If we can just give some brief answers to these questions, guys, now that'd be amazing. And I don't mind if we run over by a couple of minutes, because I really do want to make sure we get time for this. But let's just start now. I'll stop waffling so we can answer questions. Paul, I know that we were just chatting, and you said there was a question or two that you wanted to just answer off the bat.
Yeah, thanks, Sam. Just a couple of sort of quick questions, really. Had a question: is the data that I've presented Hutchings' own data, or data based on national trends from other agents? To answer sort of quickly, it's based on our own data. Mentioned it was sort of the sales data was from the 12 months up to the 1st of March of this year. It can be notoriously difficult to get hold of this sort of data in the sort of sector that we work on. Excuse me. And we don't have access to other agents' data, so it is purely based just on Hutchings data, Hutchings consultants' data, just to cover that. Also had a question about what kind of GP margins, percentage margins, do we usually sort of see for high street based pharmacies? So I've given sort of an idea of what the I guess the average figures are that we sort of see. We, as you'll be aware, we sort of cover, pretty much, we're in England, Scotland, and Wales. So there's a real sort of good sort of geographical sort of split in the data that we sort of pull together. I don't have those figures sort of immediately to hand, but I would say you're probably looking somewhere around that sort of figure for high street based pharmacies, generally sort of speaking. For health centre based pharmacies, again, it can vary so much in terms of where they're based, where any pharmacy is based, in terms of location. So it's quite a difficult one to answer. Sort of
and I mean,
sort of generally, really,
Yeah, there are a huge number of factors that kind of come into to benchmarking these kind of things. And if that was kind of what your question was relating to, trying to understand where your pharmacy kind of benchmarks against other pharmacies similar to yours, or in a geographic or kind of similar item numbers to you, then we can definitely help you do that. Who would be best placed to help with, I guess, that initial just benchmarking to see where they are? Is that Paul, or is that Artif that would be better suited for that?
I mean, from my perspective, I'm certainly happy to have a one-to-one conversation with anyone who wants to sort of discuss that sort of further. But I'd sort of say, you can look at margins in London, for example. Compared to the rest of the country, those margins that we see in London can be significantly higher than other sort of parts of the country.
Sure. Okay. So it can be, and how much that plays a factor into the kind of market value of the pharmacy is going to not be like for like. It takes into consideration those factors. Okay, so I'm just going to stop you there so we can give someone else a chance to answer some questions. But that's really helpful, Paul. And feel free to get in touch with Paul directly to ask if it's about your pharmacy and benchmarking. And I also know that Paul will reach out so you've got a communication channel anyway, so you can start that conversation. So Jamie, I know you've got a question that you want to answer, an Artif as well. Jamie, if I can just let you go first.
Yeah, thanks, Sam. A couple of questions I've seen. I'll try and skim through them quickly. One question was along how long a process is taking nowadays with the volume of multiple disposals. I don't know if that's referring to the corporate disposals and the volume that's going through, and the associated NHS change of ownership times. To be honest, in my experience, particularly over the last sort of 12, 18 months, the change of ownership applications are taking a while, and I'd allow anywhere from sort of 3 to 4 months, taking into account appeal period, notice of commencement as a sort of minimum. As a rule, transactions are taking a little bit longer than they were maybe a couple of years ago. Just because banks are taking a bit longer, they're a bit more prudent. People are just taking their time. So, I'd allow 3 to 4 months as a general starting point for a transaction. Someone sort of mentioned fees. The answer to fees from
Jamie, just before you jump into fees, I guess, yes, just as a fact, how long are they taking? Is useful information for people, but also, is there anything, and this might be too long an answer, is there anything that people can do to help with that, to help expedite? And I know maybe it's follow the advice that we've covered today in this webinar, but I mean, I guess that's it. When we're looking at timeframes, doing things that are going to expedite the process have become more important than ever.
Absolutely, and really reiterating that the points I touched on, Sam, is doing things early on, getting those processes started as soon as possible, doing the preparation at all levels just ensures for a smoother process. It allows the buyer, the lenders to get into the details without prolonging the due diligence process, the negotiations, and the like, really. So the sooner you get your advisors on board and the process started, the smoother and quicker the transaction will go.
Sure.
I think, Sam, sorry, if I just add to that very briefly, what we did, just from our experience, we do find again around the country, and there are differences between different local area teams around England, and there's certainly differences between Wales and England and Scotland and England and between each other. So, it's you're to a certain degree are sort of beholden to those sort of teams getting through those applications, and particularly fitness to practice applications as well. They can take some time to go through. They probably take longer as part of the overall process than perhaps the change of ownership part of the transaction. Fitness practice isn't always relevant, but where it is, that can be the biggest hump to get over, and then the change of ownership hopefully should follow quickly. But as I say, there is some big delays there at the moment, unfortunately.
Well, thank you. Look, we've hit 9 o'clock. Artif, I am going to let you answer at least one question. For anyone that needs to, that is time bound and needs to, shoot off immediately as the clock strikes 9. Thank you so much for joining us, and we will follow up this webinar with a recording of the whole event, so you can watch it again if there's anything that you missed or wanted to recap on. And like has been said a number of times now, we will reach out if you had any questions, so we can open that line of communication. Artif, take your time. We'll take a few minutes. If we're going to run over, we might as well run over by a couple of minutes, and take your time and answer. I know there was at least one question that you really wanted to make sure you got to.
Yeah, absolutely. What I'm going to do, I'm just going to run through maybe a couple of questions and keep the answers quite short. But as Sam has said, we will be reaching out to everybody individually and commenting on them in a bit more detail. So we've had a question come in saying, what innovative strategies have you seen owners use in improving GP margins? And I guess at the risk of stating the obvious, there's probably two ways that we would look at that. One is in terms of the cost of sales of your prescribing activities. So, how can we save money on buying? How can we improve the margin there? The other thing would be, well, what's the overall sales mix? What's the ratio of, dispensing, over-the-counter stuff and services and enhanced services, private services? So generally speaking, the more stuff that you do, which is higher margin, like services, is going to improve the overall GP margin. We also, I'm just going to run through one or two other questions very, very quickly. As Jamie said, we had a question about fees. What are the individual fees of Hutchings, Ansons and the accountants? Does it differ if asset sale or share sale? The quick answer is yes, it does differ if it's an asset share sale. It will generally be different depending on your individual circumstances, the size of your pharmacy and what work needs to be done. At Hutchings Accountants, we like to work on a fixed fee basis. So we try and quote you a competitive fee that you can then, rely on the cost not going up, even if there are other issues. I'll move on from that one. And then we've got a question here asking about saying the initial visit from Hutchings is done in secret. Should the intention to sell be kept a secret from the staff and others? And of course, that's going to be everybody's individual decision to make. But generally speaking, because you can never tell exactly what's going to happen with a sale, and knowing the business is going to be sold can affect staff morale, we mostly see sales being kept confidential until the closing stages of the sale, and that's when the staff are normally told. But as I say, it is up to everyone's individual discretion.
Sure, that makes sense. And yeah, it really is a matter for you to decide on, and we can advise you on the aspects that would affect it. Some people like to front end that discussion and be open, and some people, don't want to, incur the wrath of their workforce. So look, thank you so much, everyone. Thank you, Artif, Paul, Jamie. Thank you to the MPA for hosting this webinar for us. Thank you most of all to everyone that's attended and stuck right with us till the end. Brilliant. We will be in touch with all of you shortly. Thank you from Hutchings Consultants, Hutchings Accountants, and Anson Solicitors. Good night.
Night, guys. Thank you.
Thank you.
Thanks for listening, everyone.